this is a high reliability metric to say we are in for a bull run for the next 6 months or even longer. It could go for another year. So it's a very good time to be accumulating. That we've just coming out of this reaccumulation phase and can see that on chain very, very clearly. As we did this dip, it was an accumulation. It was not a bear market. There's a whole series of these metrics which I've labeled supply shock. And this is the equivalent of on-chain demand and supply. It's an alternative to stock to flow. It's an on-chain model. And we're looking on-chain for different ways in which to measure demand, which demand is like if you're holding Bitcoin every day, you're saying that's hodl demand. I'm holding it. I want exposure to the asset. And we look at the coins that are like that may potentially be supply. These are the coins that aren't locked up in long-term holding situations. They look likely they may be sold. So you can run the ratio between demand and supply. So those guys that aren't selling are on the demand side, and the guys that might be selling are on the supply side. And you get a whole family of supply shock metrics. And Will Clemente was the first to suggest this in running this ratio. He suggested doing it on this thing that Glassnode created called liquid supply. Now this metric was, I talked to them and asked them if they could create something that could look at the behavior of individual holders and their history, so that we could kind of validate what was happening on exchanges. We were seeing that the coins were starting to deplete out of the exchanges and move into long-term storage. But I really wanted something that was more forensically accurate than just exchanges, because exchanges are very reliant on you tagging particular wallets as being owned by exchanges, and there's a lot of data errors. So they created this metric, and it's called liquid supply, and it looks back and it goes, all right, for this cluster of wallet address spaces, because on the blockchain, obviously, you only see addresses, you don't know who it is. They forensically cluster all of these address spaces together, and they resolve them to individual holders. Now you've got the individual holders, you look back across their wallet history and you go, okay, there's three categorization. There's the what I call the Rick Astley, the guy that just keeps stacking and does not sell. For every 3 Bitcoins that's bought, no more than 1 Bitcoin moves out of or sold. So anything that's stronger than that is what you call illiquid. They're not selling. And then you've got 2 other tiers which get more and more liquid. The high liquid side is just totally nets out to zero consistently. So they're full on speculators. And then you've got the middle kind of swing tradery, part hodly guy. So you can run these supply shocks, and you get the original liquid supply shock, and that's a very good metric, even down into trading a 5 day sort of swing. And then you've got this, what we're looking at here, which is the long-term holder supply shock. And if you were to look into wallets, and because as coins enter a wallet, they kind of age like fine wine, and it's you can measure how long the coin stays inside the wallet, and there's a probability distribution that you can see. If this coin is dropped into a wallet and it's been there for 1 day, statistically the probability of it moving tomorrow or the next day or the next day or the next day, and it just starts to drop slowly and decay. But at 5 months of age, there's a cliff, and the behavior starts changing. It's it starts to drop off a cliff, and if a coin can stay in a wallet for 5 months or more, it's very unlikely there's a sea change in action that now starts to become more likely not to be sold and held for years and years and years. So this thing takes obviously 5 months for you to reach that, so it's quite a smooth, reliable metric for the macro.